Income from house property. If a person receives rent from his own building, then such income is treated as income from house property. So, if any person having an house and if he receives rent from that house, it is called as income from house property. A person can receive income from a house in two forms: profit on sale of house and rent received on let out. So the person can let out the building, or he can use for his residential purpose. But income from house property. If a person receives a rent from his own building, then such income is treated as income from house property. A person can receive income from house in two forms: profit on sale of house and rent received on let out. So the person can let his own he can provide his house on rent purpose, or he can sell the building. So in these two forms, the person can receive money from house. So here that can be let out, or that the building can be sold. And profit on sale of house is treated as capital gain, and rent received by the owner of a house is treated as income from house property. So on the sale of if he receiving any profit on sale of building, so it is treated as capital gain. And if he receiving rent by letting out, so it is treated as income from house property. Then the owner use the building in many ways. So first, the purpose is let out for any purpose. So he can let out for any purpose. So it is an taxable income, and expenses incurred on the house are considered. So if he is letting out his building, then the rent received by him, or whatever the income he received by him, rent received by him is taxable, and for running own business or for carrying profession. So income of this house is taken as nil, and expenses incurred on the house as treated as business or profession expenses. So if the owner is using that building for his own purpose, for his own business, or for carrying profession, so then it is treated as business or profession expenses. So it is not taken as income from house property under the head of income from house property. And the next type is for owner's residential purpose. So income of this house is taken as nil, but some expenses are allowed as deductions. So these are the three main purposes the owner uses uses the building: for letting out, for his own business or profession, and for his own residential purpose. And the next thing is so how the income is treated as income from house property. If the following conditions are to be satisfied to treat the earned income income from house property. Condition 1, there are two conditions. Condition 1 is the property should consist of any building or lands connected to the building. A permanent structure on the land is taken as building. A house in collapsing stage, or a house without roof and doors, or a house which is under construction cannot be treated as building. So if a building a permanent structure is treated as building, that means it should have walls, doors, roof, and these are the main things which a structure can called as building. So these are the main things which a structure has to be called as building. And if a house in collapsing stage, it is not treated as a house, and a house without roof is not also treated as building, and without roof and doors, and house which is under construction is not treated as building. So buildings are two types: buildings which require roof for using, example, for residential purpose, running a hotel business or running a personal professions. And the next thing is a permanent structure on the land designed for a useful purpose. A building which does not require a roof is stadium or swimming pool. So these are the buildings which are also called as which are the houses, permanent structures called as buildings, but without roof. Those are stadium and swimming pool. So these are also called as buildings. And if a person earning income from these buildings, then it is treated as income from house property. In addition to this, the term building includes, there are other terms also included in the building, that is bridge, storage or warehouse, factory, stalls, shop, lecture halls, etc. These are all treated as buildings. If any income is generating from these things, it is treated as income from house property. And condition 2 is the assessee should be owner of the property. So the whatever the income generating from a building, the owner, the building owner, the assessee should be owner of the building. The term ownership is to be taken in the spirit of language. So if a person is not the owner of a building, either in letter or in spirit of term owner, then income received by him from the building is treated as income from other sources. If the assessee is not owner or termed as owner, so then whatever the income received from that building is treated under the head of income from other sources. Now, ownership of a building is three types: freehold rights, leasehold rights, and deemed ownership. Now see, freehold rights means a person who acquired a house building by means of purchase or inheritance or a gift or under a will, having absolute right to enjoy the property with regard using either for living or for using self or for letting out, and to sell the property and transferring the property to anyone. So these are the main things which comes under freehold rights. Means the whole right on the building will be having a person. The person can let out the person can sell the building, the person can use for himself, his residential purpose, or he can transfer this property to anyone. So these are the freehold rights. And the leasehold rights: if the agreement between the owner and the tenant of a property is for a longer period of time, and under the terms of agreement, if the lessee constructed a permanent structure on the leased property, any rent received from the construction made shall be treated as income from house property. If a person took that building on lease for a long land for a long time, and the lessee constructed if he constructed a building on that place, and if he receiving income from that building, I mean construction, then it is treated as income from house property. And deemed ownership means if a person not legally owner of the building but enjoy all the benefits, those are called deemed owners. That means the person will not having any rights on the building, but he can enjoy all the benefits of the building. The following are the deemed ownership persons. Now, person transferring property to spouse, person transferring property to minor child, Karta of HUF, member of housing cooperative society. These are the deemed persons who can enjoy the building benefits. And now let's see the method of computation of income from house property. There are two types: when property is let out and when the property is self-occupied. So when the property is let out, when the Rent Control Act does not apply is the one method, and when the Rent Control Act provisions are applicable. These are the two methods for calculating income from house property for a let out house. And for self-occupied house, there are two methods: for residential purpose, and for if the building is using for residential purpose, or for conducting or carrying for business profession. So these are the two major types, and two sub types for calculating income from house property. Annual value. Income from house property is computed based upon the annual value. So according to section 23 under subsection 1A, the annual value of any property shall be the sum of which of the property might reasonably. So for determining annual value, following factors are considered. First is municipal rental value, and actual rental value, fair rental value, and standard rental value. These are the factors which are considerable while calculating a annual value of an house. Now, municipal rental value. Municipal rental value means value of any house according to a local authority. So it is different from one local to location to another location. According to the Indian Constitution, municipalities or local bodies are having right to levy tax. So here these municipal rental or rents are decided by the municipalities or local authorities. This right is given by Indian Constitution. For levying tax, municipalities will value the income generating capacity in the form of rent of each building. So municipal and local authorities will calculate the rent income generating capacity in the form of rent. So here municipal rental value determined by two ways. One is gross municipal value and net municipal value. Net municipal value is gross municipal valuation minus rebate or allowances for repairs and taxes for services. So next is actual rental value. Actual rental value means rent received and receivable from the tenant for the 1 year period. So here it is actual rent which is the tenant is paying to the owner for a 1 year period. And fair rental value. Fair rental value means rent of similar accommodation in the same street or in similar streets. So here, for example, if a building is there, the building rent is compared with another building when the structure and the constructed area is similar to each other, so then the rent is decided. It is also termed as notional rent. Now, standard rental value. Standard rental value means rent is fixed according to provision of Rent Control Act. And there are deductions are there from income from house property under section 24. So here one deduction is standard deduction or statutory deduction under section 24A. This is a compulsory deduction to every assessee who is having income from let out house. This deduction is only given when the house is let out. The deduction is given at a flat rate of 30% on net annual value. Now, interest on home loan under section 24B. Interest on home loan taken to purchase or construction, repairs or renovation or reconstruction of the house is allowed as deduction. So, interest on loan is allowed only when the previous assessee had interest paid. If not paid, deduction is not given. So, this deduction only given when the assessee paid interest. If he is not paid in the previous year, so this deduction is not given. Today's topic is about profits in lieu of salary. It is also related to salary. If the employer pays any amount instead of salary, it is known as profits in lieu of salary. So here, and that means if employee is receiving other than salary, those are called profits in lieu of salary. Profit in lieu of salary includes any compensation due or received in connection with the termination of the service or modification of the service condition. So it may be the upgradation of cadre or upgradation of employee and any training or any modification in the services or service conditions. And if the employee is terminated, any compensation is given by the employer. Those are includes in profits in lieu of salary. Any amount, the next thing is any amount received from the present or former employer in the appreciation for the services rendered. So it is also comes under profits in lieu of salary, because it is other than salary, other than income from salary. So these are included from into the salary. So here appreciation for services rendered, if the services rendered by the employee is makes appreciation in company, then employer gives any amount that is come under profits in lieu of salary, and refund from unrecognized provident fund. So if employer is saving provident fund, if he receives then it is also profits includes in profits in lieu of salary. Now let's see, the following are the aspects which are not included in profits in lieu of salary, because it is it becomes unexempted amount is taxable. So here the first thing is death and retirement gratuity. Death cum retirement gratuity. Gratuity means gracious payment made by the employer to his employee services rendered. So this gratuity is paid by the employer to employee for the services rendered to the company. Gratuity is paid on the eve of retirement, become incapacitated prior to retirement, on termination of employment, death or resignation. So these are the situations where the gratuity is paid by the employee. Retirement, on the retirement, gratuity is paid to the employee, or with some reasons if the employee becomes incapacitated, so at the time gratuity is paid. On termination of employee, if the employer terminating the employee, gratuity is paid to employee. Or if employee is died, so gratuity paid to the employee. And resignation at the time of if the employee is resigning from the job, at the time also gratuity is paid by the employer. And this exemption, and that means the gratuity exemption is for only government employees and state employees 12 lakhs, central government employees 20 lakhs. And for central government employees it is 12 lakhs, and for the private employees gratuity calculated according to the Gratuity Act.